Hi, my name is Jim Brees from GreenGrowth CPAs, and today I want to talk to you about 280E. So it seems like every other day in the United States, another state is moving closer and closer to passing a piece of legislation that actually further supports the legalization of cannabis. However, despite the rising acceptance of legal cannabis, there remains several federal and state laws and tax codes that need to catch up to current times. And this includes IRC 280E. But before we get started, I need to let you know the information contained in this video is meant for guidance purposes only and not as professional legal or tax advice. Further, it does not give personalized legal, tax, investment, or business advice in general. So with that out of the way, let's hop right in. Alright, so if you've never heard of it, what is 280E? Well, the IRC 280E is a piece of tax code that forbids any business connected with a Schedule 1 or Schedule 2 drug from deducting any business expenses. And since cannabis is still it's still considered a Schedule 1 substance at the federal level, due to the Controlled Substances Act, state licensed and legal cannabis businesses cannot claim normal business deductions like payroll, marketing expenses, and rent. So because cannabis businesses cannot deduct these items, they are at a serious financial disadvantage compared to ordinary non-cannabis businesses. So, for example, check out this comparison on the screen of two businesses, one ordinary business on the left and one cannabis-based business on the right. Now, they both make $1 million in sales and they both have $400,000 in cost of goods sold, or COGS. They both have $500,000 in sales and marketing expenses, okay? But there is a difference that the ordinary business can deduct those expenses while the cannabis-based business cannot. But the ordinary business only pays $35,000 in taxes while the cannabis business pays $210,000 in taxes. Now, this is simply at the federal level and it flows down into the state level as well. So the discrepancy between the two types of businesses is huge, okay? And without the proper tax planning and tax structuring, you may find yourself on the wrong side of the fence come tax time. So it's very, very, very important that you understand 280E and how to work within the bounds of it, all right? Now, the experts at GreenGrowth CPAs here have helped cannabis businesses save at least minimum $2 million on their taxes over the past few years. So here's what we want you to know about 280E. So how does 280E hurt legal cannabis businesses? Well, in order to calculate your federal income tax, usually you would start with your gross income and then subtract all the business expenses to get to taxable income. And non-cannabis businesses would then pay their taxes on that final taxable amount. Now, there's a large number of business deductions that actually benefits small business owners and non-cannabis businesses because their final taxable income is much, much lower because of those business expenses. And unfortunately, cannabis-based businesses are not so lucky. The cannabis businesses pay taxes on gross income, and they do not get to subtract any normal business deductions or expenses. So the taxable amount of a cannabis business is often double or even triple that of a regular-based business. This means that cannabis businesses do not have all those extra funds to potentially reinvest into their company or give to their employees as raises. However, some supporters of 280E often cite that, hey, this actual increased taxable benefits and all the taxes that go to the city are going to, benefit the local schools and the police departments and other public entities. While it is a great hypothesis, there has been no evidence to show that the actual dollars from cannabis companies are being spent specifically on those expenses. As always, there may be a few exceptions to the no deductions rule. For example, cannabis businesses are allowed to deduct cost of goods sold, or COGS. Now, cost of goods sold refers to all the costs involved in selling a product. For example, the packaging, the labeling, and any costs related to the sale of the cannabis. We have done a deep dive into COGS and what can be deducted under COGS in some of our previous posts, and some of those links are in the description below this video or in the blog post below this video. Now, it is best to contact a CPA who specializes in taxes within the cannabis industry, because you need to know and understand all the things that can be taken as a COGS deduction. This domain expertise of being in the cannabis space and having a lot of experience is worth its weight in gold. So, for example, you can deduct the products and the packaging and anything else directly related to the actual sale of the cannabis product. You can also deduct the invoice price for the cannabis, less any trade or other discounts. You can also deduct the electrical bills for the designated inventory areas, but not electricity in the sales areas, okay? And lastly, you can deduct transportation costs, that are with the travel to purchase the cannabis, or transportation or shipping costs of the actual cannabis. All right, so what can you not deduct as a cannabis-based business? Well, you can't deduct payroll, you can't deduct office supplies, or anything not directly related to the product, to the cost of the product, all right? So if you attempt to actually deduct a business expense that is illegal by federal law, you're exposing your cannabis business to be subject to an IRS audit. And let me give you a not so fun fact about this, okay? From anecdotal evidence coming out of Colorado over the past few years, 1 in 5 cannabis-based businesses are experiencing audits by the IRS. And let me give you some context. This is 10 times the average of ordinary-based businesses. So all in all, I highly suggest you work with an experienced cannabis industry CPA who can actually protect you against an IRS audit. And if it comes down to the fact that you get audited, they are there to make a great case for your business and protect your bottom line and protect your business. Okay, so why does 280E even exist? Well, okay, in the early 1980s, during the height of the war on drugs, a drug dealer won a case where he was legally allowed to deduct business expenses like car repairs and business supplies on his taxes. Well, the government didn't like that precedent that was set and put into motion a tax code that prevented other drug dealers from actually doing the same thing. Thus, 280E was created. And, well, look, since the 1980s, the United States has come a long, long way in terms of cannabis legalization. Today, over 30 states have legalized medical marijuana, or recreational marijuana has become legalized in at least 10 states. So, clearly, 280E needs to change in order to keep up with the demand for the legal cannabis market. A revamped 280E tax code could benefit legal cannabis business owners and allow them the additional funds to actually reinvest and grow their business and support their employees. So look, if you need help with calculating your COGS and staying compliant with 280E and making sure you do not overpay your taxes by even 1 cent, then please get in touch with the experts here at GreenGrowth CPAs and reach out to us via our website at greengrowthcpas.com, or give us a call at 1-800-674-9050. I hope this video was helpful. Have a great day, and we'll talk to you soon.